There is a number hiding inside the most ordinary investing decision you will ever make, and almost nobody opens with it. If you have spent more than 10 minutes comparing tickers like VOO, IVV, FXAIX, and SPY, this number is the reason that time was probably wasted. Quick note before we dig in, this is general education, not advice for your specific situation. You are someone who has opened the comparison tab. You see 6 index funds tracking the same 500 companies. You cannot tell which one to pick, so you have not picked any of them yet. That hesitation is the actual problem we need to solve today. Here is the receipt the title was pointing at. According to S&P Dow Jones Indices, 84.3% of large-cap fund managers underperformed the S&P 500 over the 10-year period ending December 31st, 2024. These are people paid millions of dollars a year to beat this index, and the vast majority of them lost to it over a decade. Now you might be thinking, sure, but professionals are constrained by client mandates and fund size, so individual investors might do better. That is a reasonable objection, and it is also the reason most people stay paralyzed. Because if the pros lose to a basic index fund, your obsession over which ticker to type is solving a problem that doesn't actually exist. The fund choice is not where retirement is won or lost. So what is? Stay with me, because the real answer comes a few minutes from now, and it is not what most finance channels will tell you. First, the floor. The S&P 500 is a market capitalization weighted index of 500 leading large-cap U.S. companies, which means bigger companies count more, and the whole thing acts as a rough proxy for the American stock market. When you buy any of these funds, you are buying ownership in those 500 businesses. The funds differ. The underlying ownership barely does. Now let me tell you something about the most famous fund in this category that most viewers do not know. SPY is the SPDR S&P 500 ETF trust launched on January 22, 1993, the first exchange-traded fund ever listed in the United States. It is legendary. It also has a structural flaw that quietly drains money from buy-and-hold investors year after year. SPY is structured as a unit investment trust, a legal wrapper from the early 90s, that prohibits the fund from internally reinvesting dividends or running a securities lending program. Both of those activities generate small amounts of return for competing funds, and SPY is legally barred from doing them. On top of that, its expense ratio is 0.0945%, which sounds tiny until you compare it to VOO and IVV at 0.03%, roughly a third of SPY's cost. Picture this. You put $10,000 into SPY on March of 2013. Your friend puts the same $10,000 into VOO on the same day. 10 years later, the cost gap alone meant your friend ended up about $345 ahead on a $10,000 starting balance before even considering the dividend reinvestment drag. Compound that gap over 30 or 40 years of buy and hold forever, and we are talking thousands of dollars left on the table for nothing. The principle is simple. Small fee differences multiplied by decades become large dollar amounts you never see. Here is where the AUM ranking surprises people. Some sources still call SPY the largest S&P 500 ETF, but as of July 2025, VOO sat at $688.6 billion in assets, SPY at $637.6 billion, and IVV at $627.2 billion per the street. VOO is the new heavyweight. SPY is mostly a trader's tool now. Its average daily trading volume hit $27.18 billion. Dwarfing VOO at $1.29 billion and IVV at $1.14 billion. That liquidity is fantastic if you are scalping in and out. It is irrelevant for someone holding for 30 years. Which brings us to the real reveal of this video, the part nobody leads with. The fund you pick almost doesn't matter. What destroys retirement accounts isn't picking the wrong ticker, it is panic selling when the market drops. Let me show you what that actually looks like with money on the line. In 2007, Warren Buffett made a $1 million bet against protege partners that an S&P 500 index fund would beat a basket of 5 hand-picked hedge funds over 10 years from 2008 through 2017. By the end of that decade, the Vanguard S&P 500 index fund in the bet returned 125.8%. The 5 hedge funds had total returns ranging from 2.4% on the low end to 87.7% on the high end. Not a single one beat the simple index fund over 10 years, and remember, that decade started with a market that fell 56.8% by March of 2009. Picture this scenario for a moment. The market has just dropped over half its value. You log into your brokerage account, see the red, and your stomach turns. The voice in your head says, get out before it gets worse. That voice has cost more retirements than every bad fund choice combined. Because the people who held through that 56.8% drawdown captured the recovery. The people who sold to cash watched the rebound from the sidelines and never recovered the gap. Here is the math that should anchor every decision you make from today forward. As of December 2025, the S&P 500's 30-year average annual return was 10.4%. $500 a month invested over 31 years at an average annual return of approximately 9.8% reaches $1 million. That is consistent with the S&P 500's long-run history. The path to that million is not picking the right ticker, it is showing up every single month, including the months where the market is bleeding red and your gut is screaming at you to stop. You might be thinking, but what about concentration risk? Isn't the S&P 500 too top-heavy right now? That is the exact objection a smart viewer should raise, so let's address it head-on. According to Goldman Sachs, 28% of S&P 500 aggregate revenue came from abroad in 2024. The information technology sector specifically pulls 56% of its revenue from outside the United States. So when you buy an S&P 500 fund, you are not making a pure American bet. You are making a bet on 500 large multinational businesses, more than a quarter of whose sales happen overseas. That doesn't make concentration risk fake. It makes it more nuanced than the headlines suggest. Even Warren Buffett, who has watched markets for over 70 years, instructed in his 2013 shareholder letter that 90% of his wife's inheritance be placed in a low-cost S&P 500 index fund. He knew about concentration. He endorsed it anyway. That is not a guarantee of future returns. Past performance never is. But it tells you something about how a serious long-term investor thinks about this index. Here is one situation where the standard advice fails. If you are within 3 to 5 years of retirement and your entire net worth is parked in an S&P 500 fund, the concentration math hits differently because you no longer have decades to ride out a drawdown. A 56% drop just before you retire is not the same problem as one when you are 30. We are about to tease a video that addresses exactly that, but for the rest of this conversation, assume you have a long time horizon. So you are convinced that staying invested matters more than fund selection. Great. You still need to actually pick a fund. Here's the decision matrix, brokerage by brokerage, in under 30 seconds. If you have a Fidelity account, FXAIX is the cleanest pick. Its expense ratio is 0.015%, one of the lowest available anywhere, and Fidelity has long been one of the lowest cost S&P 500 providers. You might wonder about FNILX, which has a 0.00% expense ratio. Fair question. FNILX tracks Fidelity's proprietary U.S. large-cap index, not the actual S&P 500, close but not the same. For purists, FXAIX is the cleaner pick. If you have a Schwab account, SWPPX is your fund. It allows automatic dollar amount contributions, like $200 every payday, and buys fractional shares automatically at end-of-day net asset value. Yes, mutual funds only trade once per day at the close, and for a buy-and-hold investor, that is a feature, not a bug, because it removes the temptation to time the market. Some people argue ETFs offer the same discipline if you do not trade them, and that is fair. But the friction matters for many people. If you have Vanguard or any other major brokerage, VOO is the universal answer. Its expense ratio is 0.03%. It trades commission-free on essentially every platform. Since brokerages eliminated ETF commissions back in 2019, and Vanguard's mutual ownership structure dating back to 1975 means the company is owned by its own funds. There is no outside shareholder demanding a profit margin on top of fees. IVV from BlackRock is functionally equivalent at the same 0.03%. Though worth noting, IVV uses representative sampling rather than full replication, per its prospectus. The performance difference for a long-term investor is negligible, and the choice often comes down to which provider you simply prefer. Counter thesis worth dispatching. Some people will tell you the difference between VOO and IVV matters. For a 30-year holder, it really doesn't, and the consensus across financial analyses agrees the gap is tiny. If you want full autopilot and you hate the idea of rebalancing, the Schwab Target Index Series carries an expense ratio of 0.08%. That fund automatically diversifies you across S&P 500 exposure plus international stocks and bonds, and gradually shifts your allocation as you age. The math is friendly. 0.08% on a $10,000 balance is $8 a year. Compare that to actively managed target date funds, which averaged 0.533% at the end of 2024 per Sway Research, about 7 times more expensive for similar diversification. Note, target date funds are one-size-fits-all by design, so they may be too conservative for some investors and too aggressive for others. One more nuance because it matters. Inside a Roth IRA or a 401k, the choice between mutual funds and ETFs barely matters from a tax perspective, because the account itself shields you. ETFs use in-kind redemptions to avoid realizing capital gains, but inside a tax-advantaged account, that advantage disappears. Cost and convenience become the only differentiators left. So here's the screwdriver moment. Open your brokerage app right now. Find the fund that matches your account from what we just covered. Set up a recurring automatic transfer, even $50 a month, and then close the app. Do not check it tomorrow. Do not check it next week. Behavioral discipline is built by removing the decision, not by improving it. You, the person who has been comparing tickers in a browser tab for weeks, are not behind because of fund selection. You are behind because the decision has been deferred. The worst decision you can make is no decision at all. Though I will note that rule changes if you are inside a few years of retirement, which is a different conversation. The data says staying invested through crashes determines retirement outcomes. Fund selection does not. So before you close this tab, drop a comment below telling me which fund you actually picked and which brokerage you are on, and the answers tell me what to cover next. Now, if you are nearer to retirement than you were 10 years ago, there is a window of time, probably much shorter than you think, where certain financial moves are still genuinely easy and inexpensive to make. Once retirement actually starts, some of those same moves get harder, more costly, or quietly disappear forever. The next video on the screen walks through exactly what to do if you are about a year away from leaving the workforce, and the cost of getting it wrong. This is general education, not personalized advice. Before you act on any of this, talk to a financial advisor or CPA who knows your full situation. They will catch the wrinkles a single video like this cannot.